Hey traders, Raghee here. Let's get a quick audio and video check in. Should be good to go. Hope everyone's doing great. All right, welcome. Good to see everyone. Welcome to the Raghee Report. I see the questions coming in. Let's go ahead and take a quick peek at the economic calendar to start off our show. And the idea here, gang, is that in terms of hot zones, in terms of economic events, we had a huge week last week. Everything from non-farm payroll to Apple to Amazon, Google, FOMC. What kind of calendar do we have coming up this week? It's pretty quiet. It's probably a pretty quiet week as compared to relatively to the last. Monday is going to be extremely quiet. That's not unusual. The day after non-farm, we usually don't have any major hot zones. For the U.S., going into Tuesday, again, pretty quiet, except for in terms of data releases. But come Tuesday, here comes FOMC Chair Powell due to participate in a moderated discussion at the Economic Club of D.C. Look, anytime Powell's going to talk, this is going to give him an opportunity to course correct anything that he feels we, as a trading and investing public, simply did not understand about the statement, about his press conference. And generally, if we collectively responded too hawkishly, he's going to walk that back. If we're heading in the right direction, he'll basically affirm the fact that for the first time in many months, we have a target rate probability that is not only probable, but likely by June. That means one extra quarter point hike as opposed to topping out at 4 3/4 to 5%. We're likely to top out at 5 to 5 1/4. So that's the big difference there, gang. If you're wondering, all right, what was the adjustment? Why the weakness in equities? That was what equities were adjusting for, that reality of potentially a quarter point higher. And then we have a pretty quiet week. And then going into, let's go back on over to that economic calendar, and going back into ultimately what we're going to be looking for in terms of data, whether that be earnings or whatnot. I'd say the bulk of the high impact earnings are probably behind us. We don't want to, overlook a lot of hot zones. I do like to look at estimates for that. We'll do that tomorrow when I see you all for charts and coffee. But if you take a look at the rest of the week, here comes FOMC member Williams, Barr. We have crude oil inventories, Waller. Now we're just going to get just a wave of FOMC speak into Wednesday. Things are pretty quiet again. On Thursday are typically weekly claims. And then Friday, preliminary University of Michigan consumer sentiment and a little bit more Fed speak. So not exactly a quiet week, but nothing like what we had last week. And Powell will set the tone on Tuesday and either affirm that we got it right with the last FOMC meeting, adjusting for that extra quarter point hike, or he's going to walk us back down, in which case the equity markets rally. And for whatever reason, if we weren't hawkish enough, or Powell definitely wants to see the 5 to 5 1/4 much higher or sooner, watch for that messaging. And the best, frankly, the only way to measure that is to use that Fed Watch tool from the CME, because it's instantly analyzing for us all those Fed funds futures contracts and giving us those beautiful percentages. That's what they talk about on television. It's done for us. Just use that tool. It will simplify any macro that's relevant to why we want to be bullish or bearish in this. When it comes to stocks, when it comes to treasuries, when it comes to the euro or the US dollar, it's going to be very easy to decode with that one tool. All right. With that being said, gang, let's go ahead and jump into our questions as always. All right. Starting it off with Mike, who asks, when position sizing for long-term portfolio, do I increase the size of a new purchase as the total portfolio appreciates? No, I do not, Mike. I continue to go fixed. I do a fixed bet size, and I will have each entry almost has amnesia for the entry that preceded it. Each entry is predicated on its own setup. So no, the simple answer is I won't, right? I'll focus on just more opportunities to get in. All right, next up, crypto. Hello, Raghee. Just found your YouTube channel a few days ago. Very cool. You have some great insight from more than 10 years ago on your channel. Oh, yeah, I've been out there sharing things for many, many years. I appreciate you spending the time and going back into the, oh gosh, into the archives of my channel over at Raghee Horner. Yeah, so I've got my own channel over there. And yeah, I appreciate that. We're broadcasting both on the Simpler Trading YouTube channel as well as my Raghee Horner YouTube channel. I appreciate that. I go back sometimes and look at those and think, wow, I've been remarkably pretty similar to the way I look at the market now, really consistent. And I kind of look back and appreciate that. But at the same time, I think, wow, how far have I come? And it's so cool to document my journey. I mean, I can go back and find updates that I did over 20 years ago. And it's pretty cool to have the internet basically, whether I wanted it to or not, document my journey. Thank you, crypto. Appreciate that. Put a smile on my face. Hey there, Mark. Gold, let's jump on over there. Gold has an uptrend, green structure, but it's a steep pullback on heavy volume. Does it seem like a pullback or topping pattern? All right, so let's go ahead and take a look at daily gold, which means I got to start at GC. Now to do this, what I'd rather do is jump over to the tops layout, our TOPS, and use the wave and grab and all that good stuff. So the pullback it is dramatic. You know, how do I know that? We put a measuring stick on it, right? We don't say that arbitrarily. The measuring stick is, however, volatility. Let me grab my drawing tools here. I can't find them. Where is it? There we go. So the measuring stick is, in fact, volatility. And that means that what I'm most interested in, oh, bear with me here, gang. Just turning my tools on here. There we go. All right. What I'm most interested in is the wave. That's my reversion to the mean. Okay. That's the mean, by the way. I am interested in the multi. What is the current and what is the trend that dominates, right? The dominating trend. That's my multi. Here's my mean. This is all part of that tops layout. What color are my grab candles? My grab candles are blue, but I've had a big string of green. So clearly the trend that was and the dominant psychology is still up. It's still bullish. And this is a pullback. Absolutely. Still above the 200 propulsion. Love that. Another tops tool. And I would focus on being a buyer. I would still focus on being a buyer. Perhaps one thing we could do is look at the 1 hour chart and ask ourselves, is there anything worth waiting for? Is there any setup worth waiting for on the 1 hour? This is the 1 hour chart, and waiting for this particular downtrend on the 1 hour to go yellow, to go neutral like it was. That might be worth waiting for, right? And then everything I did here, Mark, so I am saying let's wait. I am saying let's wait. Let's perhaps use the 1 hour. And then we can see how that maps to GLD or MGC. All right, we can take a look at the way that maps to the MGC futures, the MGC micro futures. That's another alternative. All right, so that is how I would break down gold and what I'm most interested in. And yes, that was a dramatic pullback. We want to give it some space to simmer down. We'll take a look at the real yields. We'll take a look at the way in which all that FOMC speak this week lands on the nominal yield of a bond and whether or not gold can get back on track, because it is a really nice uptrend that we're looking at. So I'm not going to get bearish at all. And I love that, is it a topping pattern? Not yet. Is it a significant pullback? Yes. And we can be much more discerning about how we get in. We can be much more patient by waiting for that 1 hour to go neutral. All right. So I hope that makes sense. All right. Next up, Prince asks, I noticed some of the trades that we take in Sector Secrets Mastery. Yeah, absolutely, gang. So for those of you that are wondering what SSM is, that's our Sector Secrets Mastery at sectorsecrets.com. That the first target, let's see, some of the takes we trade, that the first target, the trade isn't always up at 25%. Doesn't that make it an upside down risk reward ratio? So if we're talking about, so Prince, this is the way I would look at it. It depends on the entry. So one of the things we talk about from time to time, and I probably haven't enough as of late, is if we have an aggro entry that hits the T1, yeah, it's probably not going to be the right risk reward because aggro is, of course, right? Aggro. The moderate and conservative entries are probably inching closer to more of that 1-to-1 risk reward ratio that I pretty much like and operate from. If we have anything better than 1-to-1, that's a gift. But for the most part, I'm usually going to be at a 1-to-1 based on the support and resistance on the chart. By the time we get to conservative, it is going to be usually better than that 25-25 risk that you're referring to. But from aggro, seldom will we have the kind of risk reward that we would have if the entire trade, as I sent it out, were to be filled at each one of the triggers. So aggro, moderate, conservative. I hope that makes sense. So yes, I want to confirm what you're saying. Aggro to T1 is going to be a smaller span of price than aggro to the stop loss. Now, if that is something that's becoming problematic, if you're not scaling in at moderate or conservative or not getting an opportunity to, remember, we could always think about tighter stops if and when we need to, smaller positions. Those are all things that we can think about. So, what I like about the question is this, right? The main thing is, gang, how are we thinking about risk? And I think that's really the bigger question here. How are we thinking about risk? And one of the things that we like to do in the mastery is make risk number one. That is, we spend a disproportionate amount of time talking about that. If we can have a better than 1-to-1 risk reward ratio, great. But remember, most folks pick a risk reward that is based on, well, I bought this for 25 cents or I bought this for $5 and I want to make 10. But we always remember in the room, where is the volume or volatility resistance or support, right? What hot zones are in the way that it could increase the volume or volatility? So we try to stick with targets and stops that are based on respecting that we don't want to ever blow up our account or have a disproportionate loss in our account. And we always want to be respectful of where the targets are based on what we see, not what we would like to fulfill some risk reward. And I think when we get into it, the holy grail of trading, and this is the absolute emphasis in the Sector Secrets Mastery, the holy grail isn't an indicator, although I've created a lot. The holy grail is not market structure, although I think it's pretty impossible to trade without a clear-cut, traffic light, simple way of identifying market structure like we have with the multi-trend. The holy grail is, how many dollars can I risk for my account, and how many contracts, what's my position size, what can that be? And we have a formula for that. That's something that we do a lot of in the mastery. So for those of you wondering, yeah, is that a big deal? It's a huge deal. We have a lot of ways to adapt to higher risk or lower risk, or we have a lot of ways to adapt based on the cost of the trade. But remember that there is a formula. And if you're not formulaic, and I would even say if you're not using a fixed bet approach, it's going to be very difficult to grow an account without all those crazy peaks and valleys that a lot of traders, unfortunately, go through. All right, next up. So yeah, if you're looking for a really, really solid, repeatable process for managing risk from someone who's never blown up an account, that's really the first thing you're going to pick up over at the Sector Secrets Mastery. All right. Next up is American Express. Yes. Let's get into AXP. Edgar, my first thought is, what is XLF doing, right? Let's think about the tide before we get to an individual boat. And XLF is in an uptrend, right? So at very least, I would demand that American Express be in at least an uptrend, which, as you can see here, it is, right? Is it in a better uptrend than XLF? I wouldn't say it is, because American Express has that huge gap in the trend. It doesn't make it invalid. It just makes it a little suspect. Well, let's do this. Let's jump on over to XLF and crack it open and take a look at all the different names within this particular ETF. And you can see anything that's double green here, Edgar, I'm fine with. I'd rather, this is just my preference. I'd rather not have something with a big old hole in the chart due to earnings and a gap up. I'd rather have something that's a little bit smoother. Now you might say, Rog, what are all these crazy candles? If you might remember, gang, we had that NYSE wonkiness, and a lot of that, I believe, is from that NYSE glitch we had some time back. Other than that, heads up for earnings. We want to be long. We want to buy the dip. And any of the green stocks, Edgar, that are within XLF or fair game, including XLF itself, which is really, really liquid. All right, next up, Mr. Walker asks, how do you calculate break even after T1? I don't use trailing stop percentages. And Mr. Walker, if you have, I'm happy to go and dive deeper into this during our sessions in the sector secrets. Obviously in this show, we have a limited amount of time. Not everyone's on the same footing in terms of understanding what we do in the mastery. So some of these things are probably going to be better spent talking about it in the mastery. Charts and coffee, Raghee Report. This is not a de facto kind of tech or Q&A session for the mastery, right? Way too much nitty gritty we get into there with all the resources we have available to you all there. However, generally speaking, I don't use a trailing stop percentage, and we want to think about what break even is. And so we talk a lot about what a break even stop is in the room, whether that be for futures, whether that be for shares. We do have some folks in sector secrets that choose not to play the option setups, but instead realize that the agro, moderate, and conservative triggers that I give are also applicable to the underlying ETF or stock. So we want to think about that break even. That's part of that holy grail video series that you get when you're a member of the mastery. All right, next up, is Aussie yen still a valid indicator for risk on, risk off? Nick, I don't believe it will be again. I don't believe it is right now. And it has been in the past when the Reserve Bank of Australia had a higher interest rate and we had more risk appetite that was landing in commodities, and a calm dollar like Australia with a higher central bank rate tends to do better, tends to be bullish, better bullish, right, in that environment, while the yen with that very low central bank rate is a very popular funding currency. So the nature of Aussie yen's relationship reflecting back to stocks is that Aussie should be strong because of its exposure to commodities, and commodities are generally bullish in an environment where there's economic optimism, and the yen is a funding currency, and that all propels Aussie yen higher. But that could work for any currency that has a good chasm, a wide chasm between two central bank rates. Just yen tends to be a very popular funding currency. So you might say, well, Rog, why isn't that true now? Because all the central banks, really all these G7, G8 central banks, have been on a race to lower lows and lower lows and lower lows in their central bank rate. So when everyone's in a race to reduce their central bank rate, we're gonna lose that Aussie yen risk appetite, risk aversion reaction to equities, right? So it'll probably come back again, but it hasn't really been that effective ever since central banks, all, RBA, RBNZ, BOE, BOC, ECB, FOMC, ever since they've all been going lower and lower and lower and lower, that differential isn't there. And that's, by the way, that's also known as the carry, that difference. When the carry trade comes back, meaning that banks and institutions love to buy Aussie, sell yen, and if nothing else, take advantage of the interest rate differential. When the carry trade comes back, that Aussie relevance to risk appetite and risk aversion will probably come back too. All right. Next up, TJX. Sure. All right, TJX on the daily. A little bumpy on the uptrend, but Gru, it is an uptrend, and it's probably one of a number of stocks that we do like in the group that it exists in. So when I take a look, and I love that you're looking at different stocks in the XLY, because I'll tell you what, I think Bot and I were talking about XLY Friday and saying we need to take a look at a number of the stocks here because XLY, consumer discretionary last week, made it above the 200 propulsion, which is fantastic. That's, that difference. This is the equator, right? This is the equator. This is the bullish hemisphere. This is the bearish hemisphere. And getting up into the bullish hemisphere, pretty big deal. And then you take a look at Amazon trying to do the same thing. Look at where it was rejected by the 200 propulsion. Look what Tesla's still struggling with, the 200 propulsion. So let's make sure we are focused on stocks that are not only above their 200, but also double green. And that's something that will be fine to look at going into next week. I'm having a terrible time getting comfortable in this chair of mine today. Not good. There we go. Let's see if that's a little bit better. All right. So I am Groot. Yeah, I like TJX, but you can see it's got a few friends too. So I don't want to neglect Nike, Amazon, Nike, Starbucks. That's Lorna Bot's favorite. Those of you in the mastery. A lot of you think, Rod, Lorna Bots hate Starbucks. It's in an uptrend. It's getting past earnings. Let's keep an eye on those buy the dip opportunities. All right. Next up is what's up with UNG. I'm getting a lot of UNG questions. I mean, some of this I brought upon myself because one of our updates in the Countdown Trader was, hey, gang, we're not there yet. We're going into a seasonal cycle of bullishness. Seasonal, right? Seasonals are not setups. Tendencies are not trades, but we're going into a potentially bullish seasonal cycle in NG. But the technicals are still bearish, gang. Do not argue with that multi-trend. This is such an amazing tool down here. Look at this. That is still a red trend. We do not buy a red trend unless we hate our money, which I know nobody here tuning in on a Sunday evening does. So not quite yet. So we have the seasonals on one hand, we have the technicals on the other, and they're still not in agreement. They're still butting heads. So until they're ready to kind of make peace, there is nothing to do here other than remain bearish or remain really, really nimble. Look at an hour chart, maybe look, day trade this thing. But I've been steering clear of Natty. Till we get that movement between the seasonals and the technicals back on track. So we're just not there yet. All right. Mimi's asking about Dow. Sure. Dow's been the strongest index for some time. And when we take a look at the Dow, let's back out to that daily time frame and get a feel for what's going on there. We take a look at the Dow. Look, it's moving in a very sort of, look what's happening here. And that syncs up with this yellow trend. So this is moving more sideways, right? Well, that's exactly what the multi-trend is confirming. Do I want to be bullish? Well, every time we go down and test the 200 propulsion, probably makes sense to think about being bullish, to think about an oversold buy, to think about using a slow stow, all the things that are part of our tops layout. And then we can add to that the daily price movement range. And you can see these little tests of the daily this DPMR have been pretty good in terms of the Dow. So I would be a buyer, but it's not a trend. Now, there are trends that in sectors of the Dow, XLF is one of them. XLB is not, right? XLK, it's trying. IYT, it's trying. XLI, not. So if we go back and say, all right, at the sector level, what's in a trend in the Dow? The multi-trend takes care of that. Once we have the multi-trend confirmation, we go on over to the multi-chart and ask ourselves, all right, well, if IYT is moving higher, How do I take advantage of that maybe at an individual stock level? This is the best way to do relative performance, gang. There just is no clear way to see the participation that individual high weighted stocks have with the broader either average or in this case the sector. So you can see exactly what's moving higher within IYT or whatever you want to crack open. Let's start though with relative outperformance to the upside when we want to be buyers. All right, next up, can we take a look at TLT on the daily? Sure. TLT. So looking at TLT, I do want to be a buyer, but remember, David, what I'm going to do is I'm going to look at the more complete view of the long bond by looking at the ZB. ZB is not green. ZB is not in an uptrend yet. Now, that doesn't mean we can't be buyers in bonds, but usually when we have the FOMC coming out, we have non-farm payroll coming out, I'm not going to be interested in currencies, bonds, or gold. They very often in that window of hot zones will have disproportionate, historical volatility wise, disproportionate moves. They're far more difficult to measure in terms of what they're capable of doing when that kind of data is descending upon gold, bonds, and currencies, euro and dollar. I'm talking about specifically. So I like giving this bond, gold, even the euro a moment to sort of settle down. And then if we're going to venture into these, it might be better if we do it on the 1 hour. So I'm not there yet. I'm not looking for a long quite yet. I do want to be long, but I don't have a setup. I just don't have a setup. All right. Next up is, so gang, so I see some questions, gang, that we already covered. So I'm just skipping over those. We already talked about Aussie yen and gold. So just going to jump over those. And yeah, David, exactly. We're going to look at ZB for that. You got it. Do I have any thoughts on silver? I really don't. Silver is an old story. Silver is an old story. It's already made such a great move to the, it already had its trend. Gold looks far, far better, and so does copper. So looking at silver, it's really a matter of, can I build a watch list where I am looking at really relative outperformers to the upside? And that's where gold and copper are probably going to beat out silver. Silver has likely one thing going for it, and that's going to be a potential oversold play at the 200. A potential oversold play at the 200. The best way to find oversold and overbought, right? Think of it as high, think of it as low. What's oversold and overbought is a slow stochastic, gang. Listen to me now, believe me later. And it's just, this is something you could set up on any platform and it just works. Make your high 80, make your low 20. I've been giving this way for a long time. Telling you right now, if you're looking at a way to recognize ceilings and floors and chop, this is the way to do it. And that's exactly what I'll say. We do have chop. Look at my multi-trend. It's yellow. Here's my 200 propulsion. Beautiful. Now we're going to look for a price pattern. I don't use chart patterns, gang. Haven't for many, many years. We're going to use a price pattern, which is to say, rather than the objective support and resistance and uptrends, and rather than just drawing things subjectively, which just frankly doesn't work unless you've got an eye for this that you've been developing for years, a process that you've developed. Price patterns are really just different ways of using open, high, low, and close. Very, very different. People don't use price patterns as often. They're really old school. You look back at a lot of older charts, they're going to rely on price in a very different way. There's a lot of small price patterns that date back to even back to Schabacher's time. And you can look at Wyckoff with the tape reading, day trading Bible. Price just works because it's something we can measure. And that's what I'll look for here. I'll look for a minor low pattern as close to that 200 as possible. So that's something on the question about silver. So yeah, Ryan, I don't love it. I think copper and gold are better, but that's the way that I would look at silver. All right. Do I set up support and resistance boxes, or is that the shaded boxes of my chart? Frank, We have the DPMR, which are the yellow and gray boxes. We have the HPMR, which are the red and green. Those are completely automated. And we have our Darvis 2.0 and our Darvis 3.0. 2.0 is the free version. 3.0 is the one that has some pattern signals also built into it. And yes, it's all automated, Frank. That's one of the reasons I can sit so confidently and tell traders that you don't have to have my 30 plus years. Time is the one thing that we can't make up for. However, I think it's my job to say, look, if my process is, frankly, as good as I say, it can be automated. If the way that I find support and resistance using volume, using price, using patterns, using volatility, if it's solid, you can program it, right? It's way above my programming chops, which is why I've got the best programmer that I've ever worked with in Lornabot. And a lot of you know our indicators are just going to a whole other level with the user, the UI, the color coding, the signals, the clarity. I am just so grateful that the bot is on it with some great code. Doesn't bog down my toss, works on TradingView. So it's automated, Frank. That's been one of the things that Trish and I here at Florida headquarters have been working on for a lot of years. Can we automate what we're doing so that someone can say, Rog, can I get the 30 years automatically on the screen? And that's what I'm trying. And I have been, constantly striving for that to make it better and better for a lot of years now. So they are absolutely automated, Frank. I appreciate the question. All right. So again, just like that, how does that 30 minutes fly by? I'm sorry I ran over, but thank you as always for getting those questions out there. I really, really do appreciate it. And I just go right down the line here, gang. And I do try to give you all some good, thorough answers. So I hope that helps. Not just the person who asked the question, but a lot of you who said, Raghee, I've got a similar question. Tomorrow, I'll be right back at it again at Charts and Coffee, Monday through Friday, 9 to 9:20, right here at the Simpler Trading YouTube channel or my Raghee Horner YouTube channel. Get those questions in. I will see you tomorrow. Be good to each other. Enjoy the rest of your Sunday. Let's remember we still have a lot of Fed speak to come. We still have some heavy markets. Let's see what kind of mood we see going into 7 a.m. Eastern and whether or not Powell is going to give us some clarity and maybe the end of this higher yields, lower gold, and lower equities picture going into his Tuesday event. We'll see. All right, gang. I'll see y'all in the next update.